Everyone can find their seats. We're going to get started in just a minute. I want to thank everyone for coming out tonight to Funding and Founders. We're super excited to hear all of our wonderful panelists and discussion today. I think the state of funding in Canada is something that is a big topic. The state of funding in general right now is definitely something on everyone's mind for entrepreneurs. So we're really excited to get down to the nitty-gritty. Thank you to OneEleven for hosting us in this beautiful space. Thank you to all of our panelists, and I'm going to pass off to Sam to say the official welcome.
Hello everyone, this is Sam, I'm the Operations and Community Manager at OneEleven. We welcome all of you tonight. And if you don't know, OneEleven is a tech accelerator. We accelerate tech companies as fast and we upscale your team as fast as your companies. So if you're looking for a community, not just a space, come reach out to us. Thank you.
Moderating our panel today is the wonderful Kate Fred from Fasken, and we'll let her kick it off.
Welcome everyone. So really happy to be here during Elevate. Who is excited for Elevate? Yeah, that's right. Let's get some energy. That's what I was saying. I'm going to say 2 words about Fasken. So we are a full service law firm, myself and my team. There's a bunch of us here tonight. You folks want to raise your hand if you're the Fasken folk? There's Will, there's Chris and Laura back there, Jake. But we're here all night. If you want to learn more about Fasken and the work we do with startups, please feel free to reach out. And we'd love to thank all of our panelists for being here. We have people who are going to introduce themselves. So yeah, you are. I don't have bios here, I'm sorry. So why don't we all take 2 seconds, and I'm gonna start with Amy here. And if you want to say just, a couple words about who you are, what you do, and then we're gonna jump into this panel. Who's excited? CIBC Innovation Banking. I think it's working. Testing. Oh, there we go. My team is right here, so if anyone, Josh, Alex, everyone's here. So if anyone has any further questions after the panel, please reach out. What our group does in CIBC Innovation Banking is provide debt financing to software companies across Canada and the United States. So anything from an MRR line to a term loan, with the goal being to extend runway to provide growth capital and to provide capital for things such as M&A acquisition. We'd love to meet you, even in your earliest stage. We'd love to get to know you, find ways to work together.
Thanks, Amy. I'm Podebelskaya. I'm with Information Banking Workers. As far as sources of funding goes, I'm probably the most traditional venture fund. We are an early stage venture fund focused on fintech, primarily technology for financial institutions, fintech, embedded finance, and also some cybersecurity, right type of clients. We invest usually around Series A. We do some seed investments as well. We invest across North America, and our average check size is from 2 to 5 million, sometimes up to 7. We do take a board seat. We are usually a lead investor in the round. And again, we love to meet you pretty early. We like to meet entrepreneurs at least in seed stage and get to know you and hopefully invest.
Hi, I'm Sally Morris. I am an angel investor with both Maple Leaf Angels, which is a Toronto-based angel investment group, and I'm also a general partner with Women's Equity Lab, which is a fund that is focused on female angels. Angels invest at the earliest stages of companies, typically after the friends and family and non-dilutive funding rounds. The way it works at Maple Leaf Angels is we go through due diligence together. but the angels make their individual decisions about whether to invest in a company. Check size tends to be $25,000 to $50,000 and sometimes higher. Women's Equity Lab is a fund, and so we're investing, all the women are active investors in the fund, and so we make group decisions on our investments. Angel investors typically like to see some traction in the company, but we will invest in pre-revenue companies as well.
My name is Bernie Lee. I'm a partner with Antler Canada. So at Antler, we are first-time investors into the zero founders. So a little ahead of the angel industry, we actually will work with people who we think are just highly exceptional, that have demonstrated spikes in particular areas. I think the work with them over a 10-week period, at the end of the 10 weeks, we would be there to invest. So that's makes us the very first chat. So while we just got going, earlier this year, 2022, we are part of a larger global organization that's happening across 17 countries. Collectively at Antler, we've now backed over 550 companies, have been working with over 5,000, 6,000 entrepreneurs. So we really see this as being a platform that's here to support really ambitious people that are out to go down their founder journey, and it's happening all around the world.
My name is Peter Paul, founder and CEO of FrontFundr, kind of the new kid on the block, if you like, in terms of in the early stage venture space. So what we do with FrontFundr is really helping startups, scale-ups, and later stage private companies raise capital to fund. That's basically what we're doing. So opening up early stage investing companies to anyone who's excited to invest in companies. Empowering that through our technology platform. So you can literally go online in FrontFundr and explore investment opportunities and do your entire investment online. And so it's really about opening it up, offering companies really access to the entire capital, public, and for investors, the public, to actually get access to investment opportunities. Traditionally, it was a pretty small group of, let's say, 3% actually invest in these companies, and we're unlocking it for this other 97% to invest in these companies. And yeah, we help startups, scale-ups, private companies, and ourselves now. Today is a big day for us. We also move ourselves on our own platform. We're basically going through the process.
All right, thanks everyone. Why don't we jump into it? We're going to start with the hardest question first, I think. But 2021 was a record high year for investment in Canadian startups. There's an impending, potentially already year recession that's happening, and we've really seen that drawback happen in the private markets. Some people are saying the funding party's over, it's slowing down. What do you think the sentiment has been from an investor perspective, and how is this going to affect the various funding cycles? Sally, why don't we start with you, because you're probably kind of one of the first checks in, and then we can go along the line a little bit.
Sure. At Maple Leaf Angels, we've seen a 50% drop in funding year over year compared to this time last year. And a number of the funding rounds that we've invested in have been follow-on investments for existing portfolio companies. So I definitely think that the angels are impacted by the macroeconomic environment and probably trying to keep some dry powder to be able to support their portfolio companies through the coming times.
Bernie, do you want to answer next?
I'm going to layer on. I think a lot of people have the general sentiment that it's tough. And, yes, we can find out what happens with the economy. But the one thing that actually came out, we saw yesterday, was John Sakota with the Department of NEA, actually came out with this report, their analysis, that there's like $290 billion of dry powder that's actually been sitting and waiting. So people have not been investing right now, but there's a lot of pent up assets in the venture asset class that probably will need to be deployed. So it may not be all doom and gloom, despite what a lot of people are saying.
That's really interesting. I think it would be good just to kind of, Jane, as an institutional investor, I'm picking on people today, it's fun. Like talking about dry powder and talking about what funding looks like. Do you feel that things are being pulled back? Are you holding on to reserves for your current portfolio? What do you think the landscape's gonna look like in the next year or so?
I'm actually surprised that some funds are stepping back and slowing down their pace of investing. Last year, when everything was so expensive, valuations were so high, everybody was investing. Now that everything is cheaper, all of a sudden, let's not invest. It's kind of like counterintuitive. We haven't slowed down at all. We haven't slowed down to last year. We're just operating under the principle of just, we have our own pace and we're going on the same pace regardless of the economy. And we are looking for the best companies. We will invest around 5 companies per year, and we did that last year. We'll do this year. So there's really no slowing down. Correct, Bernie, there's actually a lot of capital that funds have right now, and there is capital to be deployed.
Fantastic. Amy, I'd love to get your opinion on this. So Sequoia, if you're not familiar with Sequoia, massive fund, they really talked about today's funding circumstances and highlighted, capital was free and now capital is expensive. What does this mean for a founder, and what should the founders really be thinking about before they set out for this race?
Kind of add to what Jane was saying. I'm not sure all the VCs are, pulling back as much as a lot of founders are maybe not even taking their capital. There's a little bit of that going on because of valuations. And you mentioned Sequoia and a number of other top tier VCs with those beautiful decks back in May, demonstrating what they thought a founder should do. And it's basically related to capital was very cheap for a while and for a number of years, and all of a sudden it got very expensive. And so people have to take a step back. We have to kind of reevaluate your business and understand the value of capital. For some of us, we kind of think it's gone to a normal level. I thought it was getting a little bit crazy. So these corporate decks that they were putting out were more telling founders to start to really focus on the macroeconomic environment, but also the economic environment in terms of how quickly it's moving. So it was a very loose monetary policy to stop any economic disaster that was going to happen during COVID. And now we have a big tightening of that monetary policy that's raising interest rates to make our purchasing power a lot harder. And that trickles down into our world, which makes VC capital, a simplified version of what's going on, a lot more expensive. And therefore you may think, if you're going to raise in 6 months, you may rethink it and want to raise in 12 months. But that means making hard decisions, and it means pulling back in areas that may be uncomfortable for a founder or a CEO. And it means cutting at the same pace that you're seeing your revenue taper off. So some revenues in our portfolio, they haven't really been affected. We've definitely seen bookings starting to be affected by the economic shift. And that's like your first kind of red flag, and you should adjust your spend accordingly. Make your runway work accordingly with what your top line is doing. And the sooner you do it, the quicker you adjust, the more power you have and the more likely your business will survive.
I think those are some really great points there, Amy, actually, because making your business survive and making those tough decisions, we've seen that a lot frequently. And we've often heard that kind of ideology of, in the past, has been growth at all costs, continue growing, just throw money at the problem. We're now seeing the other side of that coin. And there's been a lot of layoffs that's been happening. I'm sure there's some people that have been really affected by these layoffs recently. And the tech community has somewhat bounced back and has really supported everyone. But as the cost of capital raises, how should founders really start thinking about surviving these next 12, 24, maybe even potentially beyond months? Jane, I'd love to hear kind of how you're working with your portfolio and what's the advice that you would give people? And please, other panelists, feel free to jump in.
Well, going back to what Amy was just saying about capital was cheap in the last 2 years, cheap for entrepreneurs and founders. Investing was expensive for investors, but for entrepreneurs, the capital was cheap, and now it's becoming much more expensive. So when capital is cheap, it's a good time to experiment. It's a good time to experiment selling into different types of customers, maybe trying a new use case, building additional product functionality, hiring more people. And hopefully companies have been doing a lot of this experimenting in the last 2 years, because right now is the time to use the insights from all that experimenting. And because the name of the game right now is efficiency, you need to preserve capital for longer, capital is more expensive, you want to maybe postpone your raise for another few months. So how do you do that? You need to focus. You need to focus on selling to your ideal customer type. The acronym here is, I think, ICP, ideal customer profile. You need to focus on retaining your best talent that you really need. When you're building a product, you build functionality that your ICP is willing to pay for, and you know that they're willing to pay for. And you also need to look at the metrics, kind of go back to the basics. How much does it cost you to acquire a customer? What's your CAC? What's your LTV, lifetime value of a customer? What's your NDR, net dollar retention? Because, look, if you think about it, for ideal customer profile, CAC is the lowest. So you'll be able to acquire the best customer cheaper. And ideally, you learn through that experimentation of what your ideal customer profile is. Similarly, with net dollar retention, well, arguably, if your net dollar retention is about 100%, you actually don't need to acquire any new customers to grow at all, right? Well, nobody is going to stop acquiring new customers, but the message is that you have to focus on retention and retaining the customers you have, and maybe doing a little bit more expansion sales, because actually, what's going on with my microphone? I don't know. Expanding to your existing customers is always easier than acquiring brand new customers. So going back to the metrics and efficiency, and that's the advice, really, right? To extend the runway that way.
Yeah, I think that's some really good advice. Peter Paul, I don't know if you have anything that you might want to add into that, or Bernie even. I feel like we've heard from this end of the panel and not this end, which was not on purpose, I promise.
Yeah, no, I think all hopefully a lot of key points already there is that, back to the basic, it's not growth at all costs anymore. It's the best time, that's room for experimenting, and rigorous focus really on what are those activities that drive cash flow with the business, thereby extending your runway. And also, the huge sort of economic challenges as an effect on access to capital, but also what will be the effects to your revenue? What is there still to come, right? So you got to sort of be prepared for that. Is that how may for so they can counter affect your revenue stream and sort of get ready for that to get through that. So I think that's really it really comes down to rigorously focus on core activities, your core business that really drives. That's what it's really meant.
Yeah. So totally agree. Focus, right? Whatever really work. Critical milestones. If I can take a little bit of a different angle, is that it could be an opportunity. Like, think about where you're playing in a competitive space. One thing is a lot of noise that's been out there could produce a lot of people trading. So when you think about how your marketplace of customers are being addressed, not just by you, by your competitors, all your competitors are actually getting to retreat. There may be an opportunity to actually stay ahead. Just do it with a little bit of smart.
No, Bernie.
That's great. Why don't we take a little pivot here, and I'd like to talk a little bit about, what are the types of funding available? I think everyone on this panel has different kind of options and different ways of providing funding. Is there a right or wrong way to raise capital right now? Amy, did you want to kind of start us off on that?
So there's a myriad of different ways of raising funds for software I would say selfishly that financing alongside around is very helpful and kind of excellent way to extend runway. Also an excellent way to kind of invest in growth. And the way we kind of think about it since that market shift we talked about is us being able to layer on capital to your, layer on existing money onto your existing capital to kind of get you through this recession that really is about to fall on us. And so if you have 12 months of capital, nothing would make you happier than to layer on another 12 months so that you can raise in a more healthy environment to get the valuation that you want. But I'm also sitting on a panel with alternative funders here, and I don't want to monopolize it, but there's also your government grants, your shreds, your Fed dev loans, like all that fun stuff that you really should invest time in, because there's government money that is to be had. But Peter was earlier telling me all about his crowdfunding platform. It always impresses me, so I'd love to hear more and Bernie.
Thanks, Amy. I think first of all, in more challenging times like we're now in terms of raising capital, creating optionality makes a lot of sense, right? So basically, exploring alternative options to raise capital. I think it's always wise to do, because if you can go to a marketplace and explore different options, you're likely to get sort of the best price capital from your perspective. Certainly in these days where it's truly challenging, looking at alternatives, grants, revenue based and alternative revenue, alternative pools of capital, and that includes the investment crowdfunding is what is there other pool of capital, pool of investors basically that maybe it's investing. So I think that really is more important than ever from your perspective, is to explore your options and see what fits with your best fit with your business. And it's not necessarily alternative like one thing or the other, right? That's really a point that I often find really important when we talk about investor crowdfunding, sort of a new way of raising capital, but it's complementary, right? Like what I love to see is really, and we see more happening is companies can do both options at the same time. See more companies on our platform raise traditional angel networks, sometimes we see it in later stage funding, and then add on by opening it up to the public. So all in all, I think creating functionality is funding options.
Bernie, do you want to say something? I know the mic was passed to you, so. No, I'll get it. And I passed the mic over, and I feel bad. I feel like I need to apologize to Amy. My media training keeps kicking in and going like this to her. So I think let's touch on the topic of diversity really quickly here. I mean, we're sitting on a panel where over half of it is women and women funders. And I'm sorry, but that's pretty dang cool, right? Unless I remember wrong today, I'm sure everyone here saw BC's massive announcement. So yeah, $500 billion. I know, that's if there's anyone from BBC in the room, congratulations. That's so I think something that we need to kind of touch upon here is, previously diverse founders, it's been hard for them to get funding. And should this be a priority right now in the private markets? Should this be something that we are looking at? Bernie, I'd love to hear your opinions on this.
Thanks. Yeah, we think we have a pretty unique view. I think our model is a little bit different, right? We're not out looking for sales per se, but rather it's about taking a funnel of people that want to go down the founder journey and then kind of working through them, end up choosing a cohort to work with a sort of 10-year period. So we get to see a lot of different people who express interest going through that founder journey. And it's been incredible to see. If you actually just look at the names, right, you're like, yeah, this is Canada. I do joke with my colleagues that come from Scandinavia, that come from Germany and whatnot. And we talk about our diversity now from an ethnicity standpoint or different nationalities. It's really, really incredible. These are people that don't fit the stereotypical, necessarily white male, that sort of thing. It really is right across the board, from age perspective, from an ethnicity perspective, The one area that we probably should try to do better, or we could do better, is on a gender basis. In our first cohort, is about 15% women that were into the program. That's actually something that we saw from an application standpoint as well. Now we try to address that by getting into the communities where there are some of these different, people, like the genders and the, different backgrounds, so that they are applying. So that's how we try to solve it. It's an important subject.
Sally, given your work that you've been doing, what is your standpoint on this? How do you think that we can, start pushing the needle, I guess?
Well, I absolutely think it has to continue to be a priority, even in these more challenging economic times. Equity investments to women are only 3% of total investments, even though female founders represent 40% of business owners. So Women's Equity Lab was created to try to attract more women to become angel investors. Only 24% of angels are women. And if we can get more women-directed capital to help fund businesses and provide their expertise, it's going to help the whole ecosystem. We do have a preference at Women's Equity Lab to fund female founders, although it's a preference only. But I absolutely think it has to be something that the whole ecosystem continues to focus on. Otherwise, we're missing out on so many opportunities.
Just gonna add that if we just make a little bit of an effort, and it could be someone like me who's lending, or someone like Jane who's investing, or it could be someone like you who's hiring. I'm biased, so I lean on the gender part of it. I love to see more women. I don't talk to enough women in day to day, but what I've noticed is because I've really focused on women, and the way I do that is I go outside of the box sometimes. So sometimes they don't quite fit into our box, even in innovation banking, in terms of revenue thresholds, or what is their software doing, or how is it a market fit. But I'll push and I'll say, you know what, I want to do this deal because it's a woman CEO or a woman CFO, and I do it. And you know what ends up happening is you get more women coming to you. I just had a great conversation with a woman founder yesterday. She's tracking to hit 5 million in ARR. She's about to raise another fund, another equity raise. And I don't think I would have found her if I hadn't already done a handful of other investments this year. So just sometimes just have to think outside the box and we'll see a big change in it. So 15% is so low in my world, like it's really low. It's still, Bernie, it's still similar for us, but if we kind of go outside of the box, I think we can make a bit of a change there. Get that number up to 50% soon. Jane?
We've been focusing on this issue for a number of years already. I'm proud to say that even though we're not at 40% female-led companies, but 25% of our portfolio is led by women. And also, as far as hiring goes, this is advice to any of you who's ever hiring anyone. Just make sure when you are searching for candidates that you create a pipeline, diverse enough pipeline. And it's not enough to have like 1 woman to 9 men applicants. No, just make sure you have 5 women and 5 men. Pick the best candidate at the end of the day, but make sure you look at equal, diverse pool of candidates. Not just women, obviously, but we're using that as an example. Gender is just as an example.
And I think, Katie, you mentioned your private markets, and I really see this as we, open up the private market, organize both sides of the marketplace to really drive diversity. And 3% going to people founders. Those are numbers that we also want to beat by opening it up for also more people founders. Our percentage is around about 25% people founders raised through FrontFundr, and also on the investor side, where it's also compared with female net VCs, where it's think it's really, there's opportunity here as part of opening it up and, we want to actively drive that way more and measure it. So yeah, there's still a long way to go.
Sorry, just one little data point. So I said that 15% of the founders in our first cohort were female. 40% of the founders that we actually had back in were female.
Ooh, that's. Yeah, you should definitely, somebody should tweet that out, or Instagram, or TikTok, whatever the whole thing is, let's do these days. I think that's awesome. The one thing I will add on to this, because I'll have one opinion per panel, I think, is mentorship. Mentor women, mentor diverse founders. If they're not at your metric level yet, help get them there. Help make those introductions, give them guidance. I did not think that was going to be the most meaty topic of this panel, but here we are. One of the things that we learned going back into the past, and we're going to look back a little bit to 2020, is diamonds are made under pressure. We've seen a lot of these stand-up companies launch. Google, PayPal, 2000, wow. Pandemic timing, people, pandemic timing. Who am I, what am I, where am I? After the dot-com burst, we saw Airbnb in 2008, financial crisis. Who remembers that? I do, graduated university. And it's not all doom and gloom right now. I know we've been talking a lot on this panel about the recession. We've been talking a lot on this panel about people being laid off. But the flip side of that is we're also seeing a lot of founders navigate this climate and say, okay, I'm going to take this kind of what could be seen as a negative and I'm going to turn it into a positive. And I've always had this entrepreneurial spirit, and I really want to go from being a full-time employee to starting what I've been wanting to start for years. Bernie, I would love to hear kind of, with your experience at Antler, how can people start navigating that, and how can they really think about, okay, I'm going to do this and I'm probably going to do it bootstrap for the next couple of years. What does that look like?
So where we play on the spectrum, we actually think this is a great time for people that are looking to start companies. There is a lot of talent, fortunately, that might have been employed at some larger companies, being downsized, but that can open up doors, right? What a better time to actually take a bet on yourself, take a time to be bold and actually just kind of go for it. A lot of us have always wanted that. We've always had that stable, job to kind of lean back on and fall back on. But if you have the opportunity now, why not? Why not experiment right now? And when it comes to being able to survive through it, I mean, I think this is where perhaps what you see in history, some of the early data shown that like the vintage of early stage funds that come out of the succession periods, those companies go on, they succeed, they perform quite well. Could be a bunch of different reasons for that, right? The talent, pool availability might be better. Two, it's just like quotes the strong or the most focused survive, and that teaches them from a very early stage of starting their companies, lessons and discipline. They carry it with them throughout the course of building their companies. So from our perspective, we think from our stage, it's actually a great time.
Never waste a good crisis.
I really like that. I'm going to put that on my whiteboard. I feel like we deal with a lot of crises sometimes. We're almost wrapping up here, folks, so don't want to hold anyone up the bar a little bit, but in your opinion, I'm sure people have heard the term smart money, dumb money, or unuseful money, I guess, if you will. Jane, why do you think it's important to prioritize smart money right now? Why do you think it's important to look at the various term sheets and checks you have on the table and say this one is better than this one?
I actually don't think you have to prioritize my brain. I just want to make an argument here. You might not need smart money if you're a repeat founder, if you've done this before, if you know what you're doing, if it's maybe you already have a very good supporting board, you don't need smart money. But in case if you do, actually smart money can give you a lot of support and a lot of help. So the advice here is due diligence on the funds you're looking at, because every fund has different area of specialty, different focus area where they invest. So for us, it's fintech, for instance. do you want another fintech investor on your board, or you actually want someone who has more operational expertise, or maybe a fund that has a portfolio community, which we actually have. We do have one. Selfish plug. Maybe you want a company, maybe you want a fund that has an incubator. Maybe you want a fund that has executives in residence or entrepreneurs in residence that can come and help and maybe take some interim roles on your management team. So, and when you do due diligence, you should, of course, ask the fund what's that they're offering you to support you post-investment, but you should also talk to other CEOs of the companies that they invested in. Like one thing also to pay attention to, the partner that is going into the deal with you, how many other companies this partner supports? If they have 2, 3, or 15 companies, that's a really big difference, right? Because their time is going to be divided between their portfolio companies. So pay attention to that as well.
Fantastic. No, I think that's a really good point, and I will say I'm with you, Jane, on that as your former community person at IBP.
Okay, if I can just.
Yeah, of course.
Here, you know, in terms of smart money, maybe take a bit of a different perspective here as well. Like, you know, a lot of companies are, you know, we deal with companies looking for $500 million to $2 billion. Many of those are typically for VC or institutional money. Right? We often sort of forbid a sort of funding gap that we're addressing. So I think in terms of smart money, you know, see really like certainly that phase of $500 million to $2 billion. You know, where can you get it? What can those investors need to do, right? You're basically trying to get traction, great awareness. You can combine raising capital with marketing, promoting your company, your product, then it's a win-win, right? So I think it depending on the different stages of capital raising, the bigger you get, the more money you need, you probably need to have bigger pockets of money. But if you're earlier down the earlier process, then it's really about how can you find those the right individual investors as well that can advise you, and as well as reach out to a wider pretty cool great.
Fantastic. I don't know, he keeps passing the mic back. I'm like, Bernie, would you like to add something? Yeah, I mean, you gotta have one, right? All right, why don't we kind of wrap this thing up here, because I'm sure everyone's eager to get back to networking and having great conversations tonight. So I'd just like to close out, let's share some final wisdom with the crowd, and then I can actually pass it back to Selena, who I'm gonna take 2 seconds first before you do that, and just give her a big shout out, Selena with the FrontFundr team. I'm gonna throw it back to her, but Peter Paul, why don't we start at this end? Because I feel like it was this end heavy tonight.
Sure, and first of all, Eve, I want to of course thank everyone here for coming tonight. I want to thank the team. Selena has done an awesome job to put this event together, so thank you, Selena. Because Tony, this is fun for the team, sitting here with the story and every traction, things are growing, so I want to thank the entire FrontFundr team. And I want to thank the people that are, the game changers, basically, the change makers, companies that raise on our platform. That's what we today, welcome to the platform. Investors that potentially invest in private companies. That would be my takeaway. Is really, as we see all this turmoil and volatility in public markets, and a lot of short-term sentiment. So I would encourage really the public, everyone really look at the private markets, look at what's happening there with young companies with big ideas that really want to make a change in the world, and explore that and see how that perhaps fits in your, let's say, investment objectives, and really support companies that are really changing the future. So I would say look at that, there's lots of exciting.
Great. Parting words. I mean, before I arrived as a founder, so I've gone through my own tough times. And so my parting word to the crowd here is for the founders that are out there, if it feels like it's tough, if it feels like it's difficult, take a deep breath, look in the mirror and recommit and rebelieve in yourself. You're gonna get through is gonna make it happen.
My parting advice would be to focus on relationships with your investors. It's really important to be proactive with your communication. And if you need help, don't be afraid to ask. Angels can provide a lot more than just capital, and we're really happy to do so.
I would say it's really not all doom and gloom out there. If you again look at, for instance, valuations as one metric, yeah, they're down from last year, but they are still at the 2019 levels, which was we at the time thought it's pretty. They were pretty high, and we thought it was time for a recession. So we just kind of like went up and down and back to the normal growth curve. And also, as Bernie mentioned, well, there's an unprecedented levels of capital in the pockets of VCs and Ps. Why? Because in the last 2 years, when entrepreneurs were raising so much capital, so were the funds. And the funds, well, it takes several years to deploy. So there's actually a lot of capital out there available if you need it. So just focus on the metrics, going back to what I was telling you earlier, and good companies will absolutely get funded in the next few years. And we'll hopefully see new Airbnbs and Googles and Ubers. Well, something better. Let's get something better. Let's get started.
That's very good advice. I also, Sally, appreciate your advice to you need to talk to your investors and people around you and ask for help if you need it. My advice is to just be prepared and to have a bear plan. You know, everyone has their big growth plan, maybe even two, so that you're prepared and you can pivot with how the market pivots with your product. There's nothing better than being prepared to see what happens.
Fantastic. I think this is all great advice, Amy. You had the hardest position of going last on that, so congratulations. I just want to thank you all for being here with me tonight. Some really great insights, really great takeaways. I'm going to pass the mic back over to Selena here for a second, and then we're going to do it with Q&A. I think we have time for like maybe 2 questions, so maybe 3.
Thank you so much. Thank you so much to all of our panelists. You all had such great insights to share today. I'm sure everyone enjoyed what they had to hear. I wanted to take this time while you're all still seated and listening to thank everyone who's had Carbon making today possible. Thank you to Carbon Brewing for the beer today. Thank you to House Wines for the wine today. Their race just launched on FrontFundr today. So if you want to invest in, if you really like that, hit them up, go invest, let them know. Partner CIBC Innovation Banking and Fasken. Thank you to OneEleven for hosting us today. And yeah, I guess we'll open up to a question period. So if anybody have any questions, just throw a hand up. Okay, we all really want to get that. Oh. Okay, stand up. Yeah. Yes. Yeah. Okay. So my question is the following. I raised my 75 basis points today and the state is down 300,000 so what does that mean for the cost of capital? I mean, there's lots of dry powder, but what's it going to cost us? My question.
It needs to make it more expensive.
Yeah, like what? What are we looking at?
More basic question.
So I'm aging myself here, so I've seen interest rates at this level and higher, and so it doesn't scare me as much as it might scare a lot of you. I think that valuations were very crazy in the last few years and almost hitting an unhealthy point. And I think these rate hikes are kind of tempering that down and maybe putting it at a more reasonable level. The caveat there is a lot what Jean just said. And from what we see in the bank, as both investors and VCs, and also provide credit services to VCs, they're very well capitalized and they're really ready to invest. And if you have a great product and you're reasonable, I'm sure that they'll invest.
Yeah, because there is a lag between the time when capital is committed to VCs to the time when it's actually deployed. And that lag is actually multiple years. Indeed, when institutional investors see high interest rates, they can just put money into the checking version of a checking account, right? Just lend it out and get good returns on that. So they will indeed probably reduce their allocations towards VC funds, but founders will not feel it immediately if there's going to be this lag.
Hi, thank you for doing such a great panel. Question that I had, obviously, we're talking about dry powder and money still coming in. What's been really interesting is how has your criteria changed or tightened? I completely understand valuation is a vanity metric. So how has the criteria changed? And are you looking at different structures such as convertible debt? I'm going to tie it back a little bit to the public markets and to your point about the rates going up. I was speaking with someone in Vancouver, the junior mining sector. They tend to look at like when interest rates go up, people would rather park in a safe bet. So, you know, truthfully, in the public markets, you're also seeing a lot more convertible debt. And so criteria, structure, and just kind of tying it back to what you were saying.
I can do this real quick and then my colleagues here. So in my group, there's definitely been like, we call it risk, and they adjust according to market fluctuations. And you know, where someone came to me with maybe less than 9 months of capital, I might have considered layering on debt right away. I ask that when you raise, you should be layering on debt at that time. You should not be waiting for when you run out of runway. You need to come to me when you're cashed up so that we can layer on additional capital. A little bit back to what I was saying earlier. So if you have 12 months, I can give you another 12 months to get you out of this kind of conundrum that the market is in, or that you might feel because you just raised a year ago and you're scared about doing a down round or a flat round. And I don't do convertible debt, but I'm seeing a lot of my portfolio companies that are having these issues of not wanting to raise right now. They want to push it out another 12 to 18 months. They are taking on debt. So it's becoming more.
No change in criteria for us. Our investment criteria is the same, and it's just all ratios that are changing. And luckily for us, they're changing to our advantage because again, last year was really out of whack.
Fantastic. All right. I think everyone is sticking around for a little bit at least. So if you have any outstanding questions, wow, I didn't even get through it. You all questions. But yes, please go enjoy yourself, drink some carbon beer. It looks delicious. I am headed there myself.